Welcome back to another episode of Divorce at Altitude. I am Ryan Kalamaya. We've taken a fairly extended vacation from recording, but this week we have a new episode, and I am joined by my lovely co-founder and partner and co-host, Amy. What's the topic for today?
Fine. How are you going?
I'm good.
Good. Yeah, so we're going to be talking about a complicated topic, but something that comes up in pretty much not every divorce, but a lot of divorces. So we're going to be talking about separate property.
Indeed, this is somewhat of a masterclass. One of the reasons that we had a delay in recording extended hiatus was that I've had several trials, and you have as well, Amy. But one of the issues that came up in a recent trial that I had was separate property and tracing. We do have episode 29. It's proving separate property in a divorce with Andy Baum, who is a valuation expert. So if people are interested in the subject, they can check that episode out. But for the lawyers and clients and just general public out there, we thought that having a discussion on some complex issues relating to separate property, it does come up fairly regularly. So Amy, where are we going to kick things off on this topic?
So I think we need to kick things off on defining what is property and what is not property and how Colorado looks at the division of property. So in Colorado, it's not just splitting everything in half. First, you have to figure out, is it separate? Is it property? Is it separate property or marital property? And if it's marital property, then it's going to be divided equitably by the court.
Indeed. So we've had different episodes, how-to episodes on property, marital property. You can check that out. We have an upcoming episode coming with an attorney, Raj, on intangible property. So an example is a law degree. Amy, you and I have a law degree. That is not property. That issue has been addressed, and it is not property. Whereas the interest in a law firm, for example, our interest in Kalamaya Goscha is a property interest. But then once you define whether it's property or not, then Amy, what does the court do with respect to marital property and separate property? And specifically, can you give listeners kind of the baseline or context of what separate property is?
Yeah, so essentially, we have a statute in Colorado under Title 14, and it defines what is marital property and separate property. High level separate property would be any property that's acquired prior to marriage or by gift or inheritance. Any property during the marriage is presumed marital. There is a marital component to separate property, meaning if there's an increase in value of separate property during the marriage, the increase in value can be marital. So just based off of even the quote unquote simple concepts, it gets pretty complicated, I think, pretty quick.
It does. And indeed, I think it's helpful for listeners to put Colorado in context. We talked about it before, but really, when you compare Colorado to Texas, California, New York, other states, Colorado really stands out. I think it's fair to say that Colorado has the most progressive view on marital property when it comes to the relationship of separate property. What I mean by that is that most states have a similar definition where they define separate property as property that people own before they got married or at the date of when they have a wedding. So if our hypothetical divorce clients, Eric and Melanie Wolf, if Eric Wolf has $1 million in his bank account when he gets married and he just keeps that, almost every state recognizes that $1 million is not marital property. But Colorado, the difference is how Colorado views the appreciation. So other states, California, New York, and I'm oversimplifying here, is that they will delineate or differentiate active versus passive appreciation. So if Eric has a business that he owns when he gets married and he goes to work each and every day to that business, and we'll get into the kind of complexities of separate property relating to a business interest. But if Eric goes to work every day and Melanie, for example, takes care of the kids or has the homemaker role, she is allowing or she's helping Eric build that business and increase in value. So a lot of states will view that as a marital interest, that the appreciation on that business. That is in contrast to Eric has a trust fund or he has some sort of brokerage account that just sits there and increases in value that Melanie arguably didn't really have any input or contribution towards. So in other states, they will view that as remaining separate property. Colorado does not distinguish between those active versus passive, those two different fact patterns. Colorado just views the appreciation, and that is in essence the end of the analysis for that. But as you said, Amy, Colorado, it's not necessarily a 50-50 state, so we then weigh the contributions. But anything that you want to chime in on in terms of Colorado and how it stands compared to other states that you've had a relationship to or interaction with in a case?
Yeah, I think, and we're going to get into it, but in business like valuations in Colorado, the intangible assets and goodwill are accounted for. In some states, that's not the case. If you live in Colorado, I always tell clients your business probably is worth more than you think. And for divorce purposes in Colorado, it's looked at just very differently. So I think with that, Ryan, I think it would be great to tell our listeners what is the baseline in Colorado for some of those benchmark cases that we look at that give us some more guidance on like what we do with this appreciation.
Right. To determine that appreciation, one kind of fundamental concept that we haven't hit on yet is that the Eric Wolf, if he is claiming separate property, the statute 1410-113 says that he has a burden to prove by clear and convincing evidence that he owns the separate property and he can trace it back to either the gift, the inheritance, or the date of marriage and also the value. So what often happens is we will have experts that will dig in and trace the property. And that is related to that episode I mentioned at the outset in terms of Andy Baum. But when you get into these experts, and even if you don't have an expert, there's two approaches. We'll talk about approaches and we'll talk about methods. These are somewhat related to business valuations. There can be different approaches, for example, an income approach versus a market approach versus an asset approach. And in separate property, I think it's helpful to break it down into two different approaches. There's the Burford approach and then there's the Powell approach. So the Burford approach is based on a case that came out in remarriage of Burford. And that, in essence, allows the expert or requires the expert to get in to the nitty gritty and to compare and to contrast. And it is an eye-opening experience. It results in, Amy, I'm sure you've had Burford tracing cases, and they are extremely expensive. And the reason is, if people think about if there is a brokerage account. So Eric Wolf had these stocks and bonds, and he has three different stocks: stock A, stock B, Amazon, Boeing, and Netflix, for example. If Amazon doubles in price and Boeing, because they have an erosion of company culture and they can't make planes apparently now, that goes to zero. If you were to, in all things that being equal, Netflix remains the same, that if you looked at the portfolio, it would be the same today as it was when Eric either inherited it or at the date of marriage. And that's because the doubling of Amazon is offset by the loss in Boeing. But Burford says, no, that's not how you look at it. You look at it as the doubling of Amazon is marital property, that appreciation, and you don't take the offset from the loss on Boeing, which intellectually it's hard to reconcile that, but it gets to the policy that we talked about at the beginning, is that Colorado is very progressive in this viewpoint of marital property. That's in contrast to a Powell approach, which is intermarriage of Powell. That looks at more of the entity. So if that brokerage account, you could say, listen, we're going to take a step back. That brokerage account is an entity. And Powell, a lot of people, there'll be disagreements between attorneys and judges and experts about which approach applies. And Powell could be argued that it's only for retirement accounts or it's only for a real estate investment, and it really doesn't apply to a brokerage account. But Amy, anything that the listeners should know about Burford versus Powell that we haven't covered already?
One thing I was going to mention, though, like on the concept piece that people need to understand is that you can have a conversion of separate property into marital property. And I think the cases talk about that, and that might get into what we talk about further into the assets. But that's one thing to look at is did Eric have $1 million in a brokerage account, but then did he start pulling money out of that and start paying for living expenses or like changing the title on a house? So titling also matters.
It matters significantly. When you get into the Burford, when I'm talking about the brokerage account, there's the assumption that Eric had this separate account and he maintained that separate account. But for Burford, the expert would go through each and every month when there's trading, when there's active trading. The result is that there is a conversion of separate property into marital. And we'll talk about with the withdrawals and the pro rata approach versus marital property out first. But to your point, there was a recent case that just came out. It was a Boulder case that went up to the Court of Appeals, intermarriage of Caparelli, and it addressed the common scenario that you and I have seen, Amy, and that is that Eric has this property that was separate property. He either got a gift or he owned property, and then he goes and buys a house, or the parties, Eric and Melanie, go and buy a house, and they jointly title the house, and Eric takes $250,000 from his separate account and he puts the down payment on the house. That happens all the time. And Amy, can we surmise from that case and the law in Colorado about what happens to Eric's $250,000 when he uses separate property and puts it into a jointly titled asset?
Becomes marital.
It's presumed to be marital unless there is evidence that it was that the parties agreed that it was going to remain separate, or it was for convenience. I once had a case where parties had the one party they invested it with Bernie Madoff actually, and then they got the return on it, the investment, that Bernie Madoff kind of Ponzi scheme, and the parties jointly titled it in FDIC bank accounts all around. And they did that because they were trying to make it harder for the Madoff bankruptcy trustee to go back and claw back. And so that was an example of, yes, they jointly titled it, but it was only done for purposes of really not fraud, but to frustrate the bankruptcy trustee. That is a scenario where you could have a claim that remains separate property. But there are so many circumstances where people throughout their marriage, they convert separate property into marital property. And the reality is that it's going to be presumed to be marital. But if we go back to the separate property component we're going through, there are different methods that an expert or somebody can look at. If Eric Wolf, for example, has this separate property, but then he withdraws money from that, and there's no real Colorado case that says how you approach this. And I think it's helpful for listeners to understand the example. If Eric has $1 million and that $1 million is invested in just some sort of money market and there's interest that is generated from that, then let's say that they're about to buy a house and they take that he has $1.5 million. So there's $500,000 of appreciation. If he withdraws $100,000 to buy that house, to make that down payment, does the $100,000, does it come out of his separate property? And does it reduce the $1 million down to $900,000? Does it come out of the $500,000? Is it all marital property? So instead of $500,000, we have $400,000? Or is it a combination? Is it a pro rata approach? And Amy, what's the kind of result in that scenario if you take those different methods for the remaining separate property?
So the marital out would be that essentially if there was 500,000 in marital, it would mean in that account, it would mean that there was 400,000. So that's the marital out first? And then Ryan, what would happen with the pro rata approach?
So pro rata approach, you would take a combination. That you would take that $100,000 would be two parts separate property and one part marital. If I'm doing the math correctly, I could be wrong about that, but there would be a portion that would reduce. And so you can play this out. If Eric is paying credit cards and he's using, for example, proceeds from a rental property that was his separate property, and he uses that rental property or the rental income to, for example, pay taxes, to pay the debt on the rental property. We'll get into real estate next. The hardest part is when you are paying credit cards. And the statute 1410-113 has a explicit factor of what's called depletion of separate property. So frequently what we see is people that inherit money or they have money before, then the separate property never goes up. It always goes down through the marriage. Separate property could be added through various gifts, but generally speaking, it's always going to go down, and it's going to go down faster with a Burford approach compared to a Powell approach. But really what the people need to understand is that you can have experts. I've done it where an expert, I'll say, hey, expert, you need to take a Powell approach. And the other attorney will say, no, I want a Burford approach. And then within the Burford approach, generally speaking, then you'll have another argument. Do you do a pro rata? Do you do a marital property out first? And the results can be significant. If you're involving an expert, oftentimes there needs to be enough money to really justify involving an expert, because in the most expensive expert engagements, and it can be 20,000, 40,000, 50,000. I've seen them in the six figures. And it's because that Burford approach, they have to go through each and every trade, each and every month to verify where's the money. And they have to go through, and then they look at, okay, the credit cards were paid off and we have to take a pro rata approach. It gets really complex. And people, I think a lot of attorneys, I had a case that involved the difference between marital out first versus pro rata. And the attorney that was first on the case, that he ended up handing it off to me before trial because it was just out of their league. They didn't realize what the difference was going to be. In this situation, it was in excess of $1 million on the difference between those two approaches. So then the experts testify about which approach they took. And oftentimes experts will do two different approaches, but really there's no specific law or anything that says. The way that I think about it is that if Colorado has this super progressive viewpoint on marital property, you can either lean into that and say the general policy is to be as expansive on marital property as possible. And there's some support for that. If you look at income and how we define income under 1410-115, it's basically any income is income. And so it's, hey, any property, there's a presumption of marital property, and let's really lean into that. On the other hand, if you compare the case law in terms of these withdrawals, because some Texas, California, there's robust case law about pro rata versus marital out first, but they have very bright line rules and they view separate property, as I said at the beginning, very differently than Colorado. So does it make sense to have kind of a counterweight of the expansive view of marital property by having a marital out first approach, for example? Because that's how the expenses that are often paid, for example, with credit cards, they're almost always marital expenses. So is it fair to reduce that appreciation in the use or payment of credit cards? Those are the certain policy, and that's where lawyers' arguments can really make a significant difference in having a judge that understands the impact. Because if a judge is recently appointed, and Amy, you and I have talked about some of the newer judges, there's been a considerable amount of turnover in the bench, and they don't understand the impact of this. And so it's one of the reasons that we recorded this podcast, is to get into that nitty gritty and really prompt some thinking by everyone out there in the community on this topic.
Yeah, on the Colorado bench, the statistic is in the last 5 years, it's 40% turnover. We have a lot of new judges, and it's not uncommon common on some of these tracing cases. I've seen a tracing case that was a week long. It gets very expensive, but if you have newer judges, like will have to spend more time explaining.
Explaining, for example, what we just did at the very beginning about what's separate property, what's marital property, and then going in and the schedules in the expert reports they are extensive. They go on for pages and pages. And so you can get in, and then when you overlay that with, for example, what if the parties agree that they're going to pay for attorney's fees in their divorce out of marital property? That's a very common agreement. If you have separate property, then you'll say, listen, the attorney's fees, they're going to be paid out of marital property. If Eric Wolf is using his brokerage account, the stock market's been on an absolute tear and he's liquidating that stock portfolio to pay for attorney's fees. How do you reconcile that when you've got a 2-year divorce, for example, and there could be in excess of 100, 200, $300,000 in attorney's fees? And then the expenses during the divorce, are those treated differently in terms of the withdrawals? Because oftentimes people's expenses go up, but we could go down a deep rabbit hole. Amy, let's pivot a little bit and talk about different common assets or situations where separate property comes into play. What's the first one that we see the most common?
Yeah, I think real estate, we would probably agree it's the easiest one to prove. So when you're looking at real estate, essentially, you're looking at probably getting a retrospective appraisal if it's property that was owned prior to marriage. The one thing that isn't complicated, but that parties have to realize and attorneys have to realize is there's a mortgage. So we were talking about on the marital appreciation side, not only is usually real estate is going up, and then during the marriage, if there's a mortgage, that's also getting paid down. That's increasing the marital property.
You can, have an increase by both ways. I've seen arguments about, okay, the property, the real estate it's a house in Boulder and it was worth $1 million when the parties got married and it was separate property, Eric's separate property. And now it's worth $2 million. And you can do that either retroactive appraisal or retrospective, I should say. And you
Right.
can have a real estate appraiser go value it on the date of marriage or month of marriage and then what it's worth today. You can also use tax assessments when you're comparing apples to apples. And the reason real estate's the easiest is because it's just not frequently traded. So it's usually that you can go back and go into the clerk and quarters. I can go back and see a real estate document from 1920 if I really want to. But it's not as simple as the million versus 2 million, because what if Eric had a mortgage of $500,000? And that can be complicated when Eric, for example, refinances, or which commonly happens. We just had an interest rate cut. One thing that we're dealing with all the time now is, hey, I locked in a really nice mortgage several years ago. People were frequently refinancing. But what was Eric's mortgage balance when he got married? Because that is going to determine the equity that he has. And as you said, Amy, if Eric is paying down that mortgage, then that's going to result in more equity, which again gets to the appreciation. But generally speaking, real estate is the easiest. What would be the next kind of most challenging asset class when it comes to claiming separate property?
Looking at retirement accounts would be the next one. And I think Ryan, can you talk about the Powell case?
Yeah, so the Powell case, it looks at the entity approach and how much was that retirement account at the date of marriage. It happens, but it's not as common that someone inherits a retirement account. Oftentimes it's Eric, and especially Amy, when we're seeing people getting married later in life or having a second marriage, it's a fact that they have retirement savings. The issue is when they get married. And so they're separate property. The issue is proving it. And because the financial institutions generally need to maintain records for 5 to 7 years. And if you maintain the same financial institution, Schwab, TD Ameritrade, although TD Ameritrade got bought out by Schwab, and so now it's just Schwab, E-Trade or Fidelity, Vanguard. If you have the same financial institution, I have seen it where people go back and they find that statement of what their retirement account was worth, but it is more common that someone says, I had this and I can't find it. And then you get into the issue of how much was there a market appreciation and how much were contributions during the marriage in terms of the increase. Because if you had an IRA or a 401k at the date of marriage and then the spouse just moved or changed jobs and then they didn't make any contributions, one thing I've seen is, well, the S&P 500, did with Google Finance, you can figure out the rate of return was 25% over this time. And so you could back into what was the likely scenario. And it depends on that portfolio. Is it a 60-40 equities versus bonds? I've seen backing into that. Is that clear and convincing evidence? I don't know, but at least you can quantify it somewhat. But the Powell approach looks at that entity, that account, and says, what was it then versus what is it now? The Burford approach, you get into, did Eric trade? Did he invest from Netflix and then sold that and put it into Apple? And you really get into that, which kind of leads to the next problematic asset class, and that is a brokerage account. Amy, anything on that you want to say about the brokerage accounts that people should, understand?
Yeah, I think just those get harder because of, we went over the approach before, but just the transactions in and out and what like securities are being held, really looking at that and just counting the increase and not the decrease. So it gets
Right.
really
Right.
complicated.
Well, you get in most scenarios are going to contemplate a Burford approach, and again, the history, the statements. Then we move on. Beneficial interest in trusts. That is something that gets really complex. We had a episode with G. Deffenbaugh, an estate planning attorney, talking about that, and I think it's helpful for people to understand if Eric is he has a beneficial interest. His dad sets up, for example, an irrevocable trust. There's different ways that we're going to view that because in terms of the valuation, because oftentimes what's going to happen is there's going to be what was the trust worth at the date of marriage or the date of gift. And then that account often is going to increase in value because it's going to be invested in stocks, bonds, real estate, whatever. But then there's a discount because Eric, it may be based on his father's age and his father's death, and that's going to be based on an actuarial table. During the marriage, his father is getting older and is getting closer to that kind of expected date of death. So the discount becomes less. And then meanwhile, you compound that with the fact that often the investments are going to increase. But I would, suggest that the most complex or the most difficult valuation in terms of separate property versus marital property is the business that is owned at the date of marriage or that was somehow gifted. That might not be as complex when you gift because there's oftentimes gift tax returns, but the business that's owned at the date of marriage, what the business was worth versus what it's worth now is really challenging.
Yeah, one thing I was going to say about trust interest is a lot of times you'll see an irrevocable life insurance trust where the child is a beneficiary. And so a lot of times what's challenging with that is also looking at not just the transactions, but the worth or what are the assets that are like held within the trust and valuing those.
Yeah, generally speaking, my experience has been those ILITs, those irrevocable life insurance trusts. There's not much appreciation or marital property because it could say that Eric is going to receive $5 million upon his dad's death, and then his dad will pay the premiums, and that is the gift. And so each and every year there's a gift, which just keeps on increasing in value. But there's other things that we can talk about. Inflation, for example, on the marital or the gift. There's no case law in Colorado. So an example, it's just for listeners, we've gone through a economic phase where inflation is a hot topic. It will for many years, decades even, it was not really a discussion point because there was very little inflation. But just an example is if Eric received some sort of gift, let's say that his family gifted him the family business and there's an appraisal and a gift tax return. And I think we'll talk about some of the documentation to close this out. But if there was a gift that Eric received, then in 2010, for example, and it says that, the gift was $2 million and now it's worth $4 million. Part of that increase is from inflation. If you run inflation on $2 million from 2010 to now, it's somewhere in the neighborhood of $3 million, the total amount. So the appreciation just through inflation is $1 million plus dollars. So is that fair to Eric? Does Melanie get the benefit? Because if you compare that asset in 2010 to what it's worth today, you would take into account inflation. But no Colorado cases really discuss that. But Amy, I mentioned documents. What are the things that we frequently are asking our clients to produce, or that we see when we're discussing separate property in a Colorado divorce?
Just in general, documents to figure out what it was valued at the date of marriage or around the date of marriage. And then also if there's been movement in an account like an IRA or something, and there was a rollover to be able to trace that. So all the documents that show exactly like where that went. But particularly with businesses, we're looking at sometimes businesses have to be valued depending on like what they do for certain regulations on a certain, basis. So we're looking at business financials. We're looking at, was your business valued for a reason? But basically we have to prove what the value was at the date of marriage.
So the date of value at the marriage, so DOM, is I think the hardest because you're looking at bank statements, sometimes tax returns, investment statements. So the kind of gold standard is Eric and Melanie Wolf get married. We're recording this in September. Super common marriage wedding month because of the weather. So it'd be September of 2024. And then if Eric and Melanie get in 10 years, then Eric would have to come up with the statement from September. People are getting married and they're worried about this. They can save their kind of statements, net worth statements. So people are submitting credit applications or they're doing net worth statements. Seen that with financial advisors. They do these kind of monthly reporting. Those are the kind of types of documents. We mentioned before, there's the tax assessments for the real estate, profit and loss balance sheets. You can go back and ask a bookkeeper if there's been QuickBooks, for example, the balance sheet backdated to a particular date. But then I think the gifts and the inheritance, those often there is contemporaneous documentation, or there should be, because gift is the giftor. So if Eric Wolf's father is gifting him, if it's in excess of, it used to be 10,000 and now I think it's 14,000 cash, then his dad's going to have to do a gift tax return. So you can total those up. 2012 was a really common month, or a year rather, on gifting because the estate tax was about to change. We're in a climate right now where it's a political season and our election, year. And people are talking about the death tax, and there's going to be a sunset on it. Right now, the exemption is very high historically. And so that's supposed to sunset, I believe, in 2025. And so what happens is if Congress doesn't do anything, the people are going to really start taking advantage of gifting. And generally speaking, the observation I've made, Amy, is in doing this work is that families tend to have two different perspectives on transferring generational wealth or estate planning. They either gift the income or the wealth or the property early, and then they avail themselves of that exemption, and then the assets grow over time, or they hold back in trusts or something, and they say that this person's going to get this. But regardless, if someone dies and Eric receives money in an inheritance, then we're going to be asking him for the will, the trust documents, the estate tax return. And the valuations, oftentimes what happens is the IRS will go through and they need to see what was a property worth, and they'll get an appraisal, or there'll be these valuations done. And so you do see these contemporaneous valuations. It's a real challenge to have that conversation with Eric to say, "Hey, I'm really sorry that your father passed away. I need all the documentation from his estate." And Eric gets emotional and says, "This is blood money. I can't believe you're asking this." And it could be a fresh death or something that is really emotionally challenging. And you overlay that with the divorce, the emotions with the divorce, it can be really challenging.
Yeah, and it can also be complicated because sometimes parents live in other states, and so you have property in other states, and you have to look at talking with attorneys in other states. That gets complicated as well.
It does. Well, and hopefully this gives ideas to people out there, and prompts a discussion and some thought on separate property. It is a contentious issue, and it can get intellectually challenging and complex for divorce lawyers and people, Eric and Melanie, going through a divorce. But hopefully people learn something, and we always appreciate people joining us on Divorce at Altitude. If you found this helpful or informative, please give us a review on whatever podcast player you're listening to, or send this over to a friend. And we always welcome feedback via email. Our email is online, readily available. So feel free to reach out to us and say something you liked or something you didn't like. But until next time, thanks for joining us on Divorce at Altitude.